Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. One of the significant recent activities here had been the late August break higher above the July to August upper bear channel line. In the process of moving higher, prices formed an ascending wedge pattern. This pattern is highlighted in blue on my daily chart. This carried on higher until in late September, when the market's rise met a resistance that it could not overcome despite trying for 4 weeks. This was the flatlining long moving average, currently 948, which importantly did not see 2 consecutive closes over it at any point in its testing. In early October, at the high water peak of the market, prices turned down with a very interesting weekly key reversal down, heading lower and through the lower trend line of the ascending wedge pattern. The market dropped below some significant supports, and it was only in late October at the slowly rising short-medium moving average, currently at 864, that we found some support. But this did not last. 4 weeks ago, I laid out what I thought might be the possibilities here for the future, and I quote, "There are now 2 avenues that I can see for this market, though there are no doubt more available that will eventually make themselves known. First is the straightforward move down with potential targets for the ascending wedge pattern. Thus, a primary target X on the downside has already been achieved in the 860 area, whilst the secondary harder to reach target X1 is way down below in the 712 area. This leads to the second view, and something I have previously mentioned on a number of occasions, is the possibility for the whole of the July to date action being not just a V bottom, but a V bottom with an extension. Personally, it looks a little slack as a pattern, but if the short-medium moving average manages to hold the market up, well, then this second scenario, the larger V bottom with an extension, suddenly looks a lot more interesting." And that's the end of the quote. It looked very much like we had the beginnings of an up leg in a possible V bottom pattern with an extension, but the reversion back down midweek at the start of November put pay to that idea. 2 weeks ago, the medium moving average, currently at 842, which had changed from support to resistance, added pressure to the downside as prices pushed below the November 2012 low at 843 and into the congestion from July and August this year between 775 and 840. Thus, the incentive, which to be honest, as I said 3 weeks ago, was evenly matched between congestion both above and below, while it was moving more in favor of the bearish side. Then today of all days, we saw prices slip below the 775 level and into what is a fairly free space down to the 743 August low. This highlights the dominance of the break below the ascending wedge pattern as the primary driver, and target X1, the secondary target for the break below the ascending triangle in the 712 area, is actually really looking very, very good at the moment. Below the August low, we have the March 2014 high at 725 and the October 2013 high at 721. Then we have target X at 712. But we don't seem to have that much until the January 21 high at 693 as support below. Chicago corn. Here are some of the key elements from my comments formed over the past few weeks. The first element is the reverse head and shoulders pattern over July and early August. It turned out to be a good one, especially the slightly optimized neckline currently at 717, which had been incredibly supportive until the start of November. The primary target for this reverse head and shoulders pattern had already been achieved some while ago, but the secondary harder to reach target in the 714 area was just too high. Secondly, what's the impact of the long moving average actually on the market, currently at 695. This earlier had tried to cap the market, but as it separated from the 50% Fibonacci line of September 21 to April 2022 move at 661, its efficacy as resistance was being questioned. 4 weeks ago, it became both support and resistance, and 3 weeks ago, purely resistance. Finally, and most important of all, there is the July to date ascending wedge pattern, highlighted in red trend lines on my daily chart for ease of viewing. I personally found this to be the most elegant of all the elements. In mid-October, the market exited this pattern, and for a couple of weeks it seemed the prices were looking to see if there was enough bearish pressure out there to push prices lower. Well, 3 weeks ago we found there was. Hence, I initiated primary target X for the break below in the 648 zone, for secondary harder to reach target X1 in the 550 zone. Now, I did raise the question 4 weeks ago as to whether there was either a very large V bottom or bearish halfway hesitation pattern here in the making. I pointed out that one or both of them needs to show themselves right soon and in force. Otherwise, not only will the 648 level be in the frame, which it is already, but the 550 level will start looking very, very attractive. The market made a move down through what on the surface is a strong triad of support consisting of number one, the 50% Fibonacci in September 21 to April 2022 move at 661. Number two, a little below that, the gently curling higher medium moving average, currently 660. And finally, three, the lower time, currently at 659, of the September 21 to July 22 bullish Andrews pitchfork. As I said, on the surface, this would seem a pretty good support zone, but it wasn't, as by today the market had punched down through all three and managed to reach the primary target target X in the 648 zone as I was actually compiling this commentary. Question now is very much, will 648 hold or will prices continue lower? If they do move lower, well, we really don't have much below until the lesser Fibonacci lines in the 622 zone. However, there is potentially another target below. Target X2 in the 627 area is the potential target for the very late October to date action, being a possible bearish halfway hesitation. This is only becoming clear now, but it would be a very interesting stop-off point on the way down to target X1 in the 550 zone. It would depend on what happens in the 648 zone. One final thing to note. We are set up today for a weekly key reversal. If we close tonight either over 672 or under 670, then we're beyond. Right now, we are looking at a weekly key reversal down, and that is just the icing on a cake below the big move below that lower time. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.